Welcome back to the deep dive. Today we've got a story that, honestly, it sounds like financial fiction. It's almost too incredible to be true.
It really is. We're going to be taking a forensic look at Ted Weschler, who a lot of you will know as one of Warren Buffett's lieutenants at Berkshire Hathaway.
Right, but this is about the time before Berkshire. This is the story of how he took a pretty modest retirement account, about $70,000, and grew it into an astonishing $264.4 million.
And that's the key point. This isn't some tech IPO lottery win or an inheritance. This was done almost entirely through deep value stock picking, all within the rules of a standard retirement account anyone can open.
It's a total outlier, but one that actually has a roadmap we can follow.
Exactly. It's a masterclass in strategy and discipline. So today, our mission is to unpack that for you. We're going to break it down into 3 distinct phases.
We'll look at the accumulation phase, then the hyper-compounding phase, and finally the tax efficiency phase.
It's really a blueprint for compounding.
Okay, let's unpack this. Let's start at the very beginning with phase 1, the genesis and the crucible.
So this all starts in 1983. Weschler graduates from Wharton, and he takes a job as a junior financial analyst at W.R. Grace. His salary was about $22,000.
And the foundation for this $250 million fortune was something the sources call the simple habit.
Yeah, and it's not revolutionary, but it's the consistency that matters. Even on that salary in New York City, he just religiously maxed out his contributions to his employer's retirement plan.
And W.R. Grace had a really generous matching program, right? Like 50% or even 100%.
A huge match. And he saw that not as a perk, but as a guaranteed risk-free return on his capital.
It's basically free money. If you don't take it, you're just turning down a raise. It's that simple.
Absolutely. So that discipline, plus, the bull market of the late 80s, helped him build a real capital base. By 1989, when he's just 27, that account is at $70,385.
$70,000. We should probably pause there because that was a lot of money in 1989. It's something like $170,000 in today's dollars. A very serious seed.
A very serious seed. But the really critical move, the one that changed everything, happened that same year.
This is where he goes from being a passive saver to an active investor.
Right. He rolls the whole thing into a self-directed IRA. That was the key. It let him break free from the boring list of mutual funds from HR and start picking his own stocks directly.
But the moment he takes the wheel, the market just decides to teach him a brutal lesson.
Oh, it was a baptism by fire. His very first full year of active management in 1990 was an absolute catastrophe.
What happened?
The portfolio suffered a 52% decline, a 52% drop. That $70,000 he'd saved up plummeted to about $33,000.
Wow. I can't even imagine the panic. To lose half of your life savings in 12 months? That would make most people swear off stocks forever.
Most people would have sold everything and gone to cash. And we see the specific losses. He lost 67% on a stock called Continental Health Affiliates, 55% on some bonds. Just brutal.
So what kept him in the game? This is maybe the most important part of the story.
This is the unmonetized lesson, as we call it. It's a huge psychological turning point. He didn't panic. Instead, he analyzed it and concluded his mistake wasn't taking risk. It was the kind of risk he was taking.
Meaning he was speculating, not investing.
Exactly. He realized he needed to do the deep, fundamental work, and he had the perfect training ground for that in his day job. He just co-founded a private equity firm, Quad C Management.
And private equity is a totally different ballgame.
Totally different. You can't just sell tomorrow. You're locked in for 5-7 years. So you are forced to do exhaustive due diligence. It makes you see a stock not as a ticker, but as what it really is.
As fractional ownership in a real business.
Precisely. And that mindset shift is what fueled the explosive growth in phase 2.
Okay, phase 2, the hyper-compounding engine. This covers the period from 2000 to 2011. You have to remember the context here.
A lost decade.
A lost decade, exactly.
Yeah.
The S&P 500, after the dot-com bust and the financial crisis, basically went nowhere. A cumulative return of pretty much 0.
0% for the market. But Weschler's personal account, which we can proxy with his hedge fund, Peninsula Capital, did something. Well, something almost unbelievable.
What was the return?
Over that same period, it returned a cumulative 1,236%. That's about 26% a year annualized, while the market was dead flat.
That is just staggering. So
Yeah.
how do you do that? The secret wasn't some complex algorithm, was it? It was actually the opposite.
It was extreme concentration. He threw out the textbook on diversification. He would typically own only, say, 9 to 15 stocks.
And the concentration within that was also extreme.
Absolutely. His top 2 or 3 positions would often be 50, 60, sometimes 70% of the entire portfolio. This just magnified the impact of his big winners.
So let's talk about those home runs. This is where you see the genius at work. Let's start with W.R. Grace, his old employer.
Right. So Grace files for Chapter 11 bankruptcy in 2001. They were buried under 100,000 asbestos lawsuits. The stock collapses to about $1.30. Wall Street writes it off as worthless.
But Weschler knew the business, and he saw a legal angle everyone else was missing.
He did a deep forensic dive into the U.S. bankruptcy code, specifically a provision called Section 524G.
Okay, let's break that down. What does that mean for an investor? Why is that important?
It's a great question. Basically, it's a legal tool that lets a company channel all its asbestos liabilities, past, present, and future, into a separate trust. It walls off the healthy part of the business from that specific crippling risk.
So it's like a legal quarantine for the liability.
That's a perfect way to put it. And his calculation was that if they could pull this off, the core chemical business, without the asbestos taint, was actually worth closer to $24 a share.
So while the market is screaming asbestos, he's quietly reading the bankruptcy code.
And he didn't just buy the stock. He got on the equity committee to help steer the process. He held it for a decade, and the result was roughly an 11-fold return. An 11-bagger.
That's the definition of analytical alpha, finding an edge where nobody else is looking.
Now let's look at another one, Cogent Communications. This is right after the dot-com bubble burst. The telecom sector was just a wasteland.
Total carnage. But again, he sees opportunity in the wreckage.
Yeah, he identifies Cogent as the scavenger. They were buying up all this distressed fiber optic cable for literally pennies on the dollar. His big insight was to bet on the operator of the network, not the company that spent billions building it.
Because the operator has the better unit economics?
Far superior. And as internet traffic started to explode, Cogent was perfectly positioned. That bet turned into a 13-fold return.
So we've got asbestos bankruptcy, a telecom wasteland. And then he finds a gem during the 2008 financial crisis. In junk mail, of all places.
Right, Velasas Communications. They did coupons and direct mail. In 2008, with everyone predicting the death of print, the stock got crushed. It fell to between $1 and $3 a share because the market was terrified of its debt.
So what was the tiny detail that he found in the fine print that everyone else missed?
The market was panicking about bankruptcy, right? They thought the company would run out of cash. Weschler actually read the debt documents, and he found that their biggest loan, a term Loan B, didn't mature for 7 more years.
7 years. That's an eternity in a crisis.
It's all the breathing room you need. It completely removed the immediate threat of bankruptcy. And he saw that their cash flow was actually pretty stable, and they were using it to aggressively buy back their own stock at those ridiculously low prices.
That's created massive value for the remaining shareholders, another 10x return.
The pattern is amazing, isn't it? Asbestos, junk mail, plumbing. He found value in these ugly, complex situations where Wall Street was just too scared or too lazy to look.
And we should also mention DaVita, the kidney dialysis provider. That was his long-term compounder.
That was the exception. Not a special situation, but a fantastic business with a secure revenue stream from Medicare and a duopoly structure. He held that for decades and even got Berkshire to invest in it.
So these incredible concentrated bets compounded and compounded. And by 2012, that initial $70,000 had become about $131 million, which brings us to phase 3.
The tax efficiency singularity. The account had reached this critical mass, and now he makes maybe the boldest move of his entire career.
The Roth conversion.
A truly staggering move. So for you listening, to convert a traditional IRA to a Roth IRA, you have to pay income tax on the entire balance all at once, up front.
He had to pay taxes on $131 million. In 1 year.
Correct. The sources say he voluntarily wrote a check to the federal government for approximately $28 million in 2012.
Wait, and that money, that $28 million, had to come from outside the IRA, right?
That's the crucial part. He had to have that much cash just sitting around to pay the tax bill. It's an unbelievable level of conviction.
It's the ultimate high conviction trade.
It was a massive, non-refundable bet that, 1, future tax rates would go up, and 2, that the power of decades of future tax-free compounding would dwarf that $28 million upfront cost.
I mean, the math is just so powerful at that scale. In a Roth, when you get a 30% gain, you keep the whole 30%. Forever. The geometric effect is astronomical.
And the bet paid off. We know this because in 2021, ProPublica got a hold of the data, and by 2018, the account had reached $264.4 million.
And that report, of course, kicked off the whole Lord of the Roths debate. The argument being that these accounts were meant for the middle class, not to shelter $250 million.
Right. And Weschler's response was actually very measured. He made 2 key points. First, this was all done with publicly traded stocks, not some private valuation games. And second, he did pay his taxes. He wrote that huge $28 million check.
He even said he supported changing the rules for accounts once they reach a certain size, which is a Pretty remarkable thing for him to say.
Very remarkable. He agreed with the policy critics, essentially.
So as we kind of synthesize all this, we have to touch on how we even got to Berkshire Hathaway, such a classic story.
It is. He won the charity auction to have lunch with Warren Buffett. Not once, but twice. He spent a total of $5.25 million.
It was philanthropy, but with a built-in career option.
Exactly. It gave Buffett a way to get to know him as a peer, not as a job applicant, and now he and Todd Combs manage over $30 billion.
Yeah, and he hasn't lost his touch. Just look at his investment in Dillard's in late 2020. Everyone assumed department stores were dead.
But he did the same thing, ignored the narrative, focused on the balance sheet. Dillard's owned its real estate, had very little debt.
And the stock went from around $25 to over $400. The Wechsler algorithm still works.
So let's distill that algorithm for you, the listener. What does this all mean? There are really three core components.
Okay, first you have the structural alpha. That's using the Roth IRA to eliminate tax drag. Just letting the money compound without the government taking a piece every year.
Then you have the psychological alpha. This is the iron stomach to handle that 52% drawdown and not panic. It's the courage to run into the fire in 2001 and 2008 when everyone else is running out.
And finally, the analytical alpha. This is the 60 hours a week part. Reading the fine print, the bankruptcy codes, the debt covenants, better than anyone else on Wall Street.
And it's important to mention Wechsler's own advice for most people. He says, start early, use stocks, ignore the noise. But, and this is a huge but, he says if you're not willing to do that analytical work.
Just buy the S&P 500 index.
Exactly. And that's a really useful comparison. If he'd just put his $70 K into an S&P 500 index fund back in 1989, he'd still have ended up with about $1.6 million.
A fantastic outcome. A great retirement. But it's not $250 million.
It's not. His story really proves that markets can be deeply inefficient, especially when fear and complexity mix.
So we've seen the whole journey. From a $70,000 seed and a devastating crash to using arcane legal details to find 10 baggers, all culminating in this $264 million tax-free fortune.
It's incredible. And here's the final provocative thought I want to leave you with. In 2012, Ted Wechsler chose to write a check to the government for $28 million for nothing more than the promise of future tax-free growth. Just think about the insane level of conviction and long-term thinking that requires. Was that Roth conversion, a tax move, actually the single biggest, highest conviction trade of his entire career?
Something to think about. Thank you for joining us.